It's now time to bring you a first feature on the show today. Now, going by the economic disruption caused by the COVID-19 pandemic in the year 2020 and still reeling on in 2021, the Nigerian economy went into a free fall in the second quarter of last year as tumbling international oil prices poisoned an already difficult situation. By the end of the second quarter, the country's gross domestic product, a measure of economic output, shrunk about 6.1% before recovering gradually again, but with a smaller level of contraction at 3.62%. Now, the 2 quarters of negative GDP growth notched the economy into an official recession, with job loss rates rising and also inflation rates scampering higher. Now, according to the latest GDP report released by the National Bureau of Statistics, the country's fragile economy advanced 0.51% on a year-on-year basis in the first quarter of this year, slightly faster than the 0.11% rise it also recorded in the previous period. Now, this is the second consecutive quarterly growth since the country's economy dipped into recession in the third quarter of last year. However, for the first time now in recent reporting records, the National Bureau of Statistics may be confronted with some level of controversy over its headline macroeconomics statistics as well in the gross domestic product, as economic watchers rejected the seemingly positive real sector figures in the first quarter of the GDP report, arguing that the facts on ground in the real sector do not necessarily support the NBS figures, though they describe the statistics as pleasant surprises. Now, in the same vein, the inflation figures released by the NBS in the month of April also shows that inflation dropped 0.05% to stand at 18.12% from 18.17% recorded in the month of March. They say development there are many economic analysts also opine does not necessarily reflect the reality or the experiences of most Nigerians as food prices and other macroeconomic fundamentals are yet to go abated. Now, to discuss this and much more, I have with me, joining me via Skype this afternoon, Chief Consultant B. Adedipe Associates Limited. Good to have you on the show this afternoon, Dr. Biodun Adedipe.
To think you're amazing and admire you.
Good afternoon, Tolu.
It's wonderful.
My pleasure to meet you this afternoon.
Now, there seems to be this air of mixed reactions, concerns raised, reactions following the GDP and inflation report from the National Bureau of Statistics. Now, this air of controversy is around the headline macroeconomic statistics, the gross domestic product report, as well as inflation. What do you make of the rejections of this report from the organized private sector, arguing that the facts on ground versus what we have in terms of the reports do not necessarily tally?
Well, thank you very much for that issue you brought up for discussion. First, I want to say that oftentimes the general attitude we have in Nigeria to data is not encouraging, and I say that with every sense of responsibility. We somewhat tend to trust data when it posts something negative. But whenever the data says something positive, we kind of, disregard it. And we think it doesn't amount to anything. And that indeed, to me, as an analyst, is the major problem in development planning in Nigeria. We often have little respect for data. The first thing in planning is to recognize that there is some measure of integrity in the data we are dealing with. So what you now find mostly with us is that anytime the NBS issues GDP data that shows that the economy is contracting, we gleefully accept that and we say this is a reflection of what is happening. But whenever the same data posts the fact that there is an improvement, no matter how little or marginal that may be, we begin to challenge it and also put it in disrepute. So that said, what I want to say essentially is that my own take is that this data we deal with today is a reflection of the surveys conducted by MBS. And to that extent, if we believed it when in the last 5 years, the same agency put out data that showed that the economy went into recession, I have no reason to doubt the validity of the data that says the economy grew by 0.51% first quarter of this year. But what we should be talking to is not disregarding the data, but saying that yes, the economy is growing, but it is very sluggish. And in fact, by the time you play the data on the chart, we see clearly that even at the 0.11 positive growth rate of fourth quarter of 2020, we were better in terms of the rate of growth, that's the speed, compared to what we had in the first quarter of 2021. That is what you get when you interrogate the data, when you see it on the chart. So that means the question should be, why is it slowing down? Okay? And the reality, again, we must remind ourselves so that we don't go, let me say, academic and, of course, merely technical in our analysis, is take the GDP position end of March 2021 compared to the end of March 2020. Okay? There is a 12.525% growth in our GDP from 35.65 trillion to 40.101 trillion by the end of March this year. So the economy is growing. So the issue is it is not growing fast enough. And why is that so? There is something we must also pay attention to. And that is the fact of the aberration we have always had, which has not changed till date. And that aberration is that the oil economy accounts for less than 10% of our GDP. And on the other hand, it accounts for the bulk of our foreign earnings. So there's a disconnect there. So that has not changed as at the end of first quarter. So we should be asking ourselves, what must we do to ensure that that changes? Now, that on one side. The other side now is looking at the oil GDP itself, which contracted by 7.27%, which means even the oil we looked at for foreign earnings contracted during the first quarter. So what does that mean? It means new investments are not coming to that sector, but that's a reflection of what happened in 2020 and possibly 2019. So that we are now seeing in terms of actual results in 2021. So now, new investments are not coming in. Question is, why? Which means there are certain things we are supposed to have done, which we left undone. So if we want to see a reversal of that, then we need to address that, especially the petroleum industry bill, which needs to be signed into an act, and we get it into operation and run. Secondly, if you look at non-oil GDP, that also grew but very sluggishly at 0.9479%, which was lower than the growth rate that non-oil sector achieved in both the first quarter of 2020 and the last quarter, that the preceding one, fourth quarter of 2020. Which means even that sector that have provided the growth we have seen in the last 3 to 4 years before the recession came, also became sluggish. So which means we have a difficult situation on our hands today. Oil sector contracting, then the non-oil sector growing sluggishly. So the question is, what do we need to do there? 6 major sectors of this economy, if you look at contribution to GDP, agriculture, again, look at it in the first quarter of this year, the contribution of agriculture contracted from where it was December 2020. Again, the question is, why is it so? It is quite obvious, okay? And I remember citing this warning to our government early 2017, when we began to play around the politics, weaving semantics and all manner of things around what we call then the farmer headers clash. And I said 2 critical things we are discussing today. One is production of agric, that agric output will be affected adversely. And I also mentioned that this was likely to cause food inflation to spike. That is about 4.5 years ago.
Exactly.
Which is what we are seeing today.
Exactly.
Okay? Yes, please.
Dr. Adedipe, now, if I may just butt in here, yes, we have to respect the report being churned out by the National Bureau of Statistics. This has been the bureau that's churned out reports over the course of the year, and we've all gone along with the reports. But now, in still trying to understand this air we're trying to whisk away in terms of understanding the figures versus what's playing out in real terms, if I may just ask you now, for the month of April, what was your forecast for inflation?
Well, for April, we had 18.12%, which was a marginal improvement over 18.17%.
Exactly. Exactly. Now, for so many analysts, prior to the report coming out, there were indicators or forecasts that it would be at about 18.5% to 18.7%, some even inch closer towards 19%. So it came as a surprise that going by the current indices we have on ground, that we are doing much better in terms of the volume of inflationary pressure we have to deal with. So do you think right now, in real term, what we have on ground translates to the figures we're having?
Yeah, you see, the problem I have with most of our analysts is that when we interrogate data, we look at what is happening around us. Now, let me be, frontal with you on this. My company used to do inflation survey in Nigeria in the last 20 to, let me say, up until about 12 years ago, before we realized that it did not amount to anything because our surveys were basically in the Lagos markets, all right? So now you cannot compare what you find in the market in Lagos with what happens nationally. So we then decided in BA Consult about 12 years ago to stop that survey, which involved going to the market, getting prices. We constructed a basket of commodities from which we were constructing an index. So that index became the basis for generating indicative inflation rate. So when we came to that point and said, look, we've seen the investment of federal government, the World Bank, and some other development partners to improve the quality of data that MBS was churning out. And we said, if there's an improvement in the quality by reason of what has been done, why should we be wasting resources and time going to construct an inflation index of our own? So we stopped it. So the reality is that most of the analysts that query what we see today are looking within their own immediate vicinity. Now, unless any of them will come up and tell me that you have 30-something thousand outputs that conduct survey that MBS does, then I can possibly look at such data and want to believe it. But if you don't have up to 30-something thousand agents out there in the markets all over Nigeria that are getting data, real-life data, are quick to now crunch and generate an index from which to compute the rate of inflation, then I will have no regard for whatever you say with respect to that.
So simply put, you're saying the opinion is skewed.
Yes, you see, my point here is that the data that I look at, which comes from a survey of the entire country, is superior to any localized data in any location in Nigeria. That's my view about it.
Okay.
So I would rather talk about why is the rate that high? What can we do?
Now, let's talking about what we can do now at this point in time, Dr. Adedipe. Yes. Looking at the fact that we have quite a very strained environment in terms of our foreign exchange regime. The Central Bank of Nigeria is doing its best to ensure that we have liquidity injection as much as possible. It's quite difficult for government to have an aggressive investment drive, talking about manufacturing, agriculture, to be able to keep things afloat. For any economy across the world right now, it is tough. Now, at the end of the day, looking at how much we have to borrow as well versus the GDP contribution in the short term, what do you think we can do in terms of our allocations and ensuring that we are putting our best foot forward? Because conversations around borrowing for infrastructural development or capital projects is also being questioned by the populace.
Well, if we look strictly at the economics of it, the reality of investing in infrastructure is that it not only creates immediate jobs that run through the different cadres of the labor market, but secondly, it creates assets that, of course, will improve productivity, which, if it works through the entire system and the sectors, will improve also revenue generation that also backs into tax revenue for the government. So this is the way it normally runs, which means borrowing to deliver infrastructure is in the right direction. That is borrowing for projects.
Yeah.
But there are two important things we bring into that conversation. And that is, if I have to borrow for infrastructure, I must also consider the cost of that infrastructure, which means how cost effective am I in delivering a kilometer of expressway? How effective am I cost-wise in terms of delivering 1 kilometer of, standard gauge of railway to lines? So in which case, it's not just about borrowing to deliver infrastructure. We must also look at the cost effectiveness of those projects. Those are areas we should begin to interrogate. All right. So if we get value for money, which we've been talking about, but not so serious in terms of bringing that out, compare ourselves dollar per kilometer with what happens in other countries. And then assure ourselves that, yes, we are cost effective in terms of delivery of infrastructure. Then I will not have to worry my head about borrowing to do that. But where I cannot immediately say that I am comfortable with the cost of delivery of the infrastructure, whether I borrow little or much will still be a concern to citizens generally. I think that is the real issue here. So it's not so much as borrowing to deliver infrastructure, but at what cost? Of course, the borrowing itself, if it is coming at a very low rate, that is also good. And the loan itself is long tenor, which means we repay over a long period of time. And that means how much you have to repay is also within what we have capacity for. So coming to the issue of exchange rate, you see the problem with us here, when we analyze issues in Nigeria, and it's really unfortunate for me as an analyst, is that oftentimes we want to eat our cake and have it.
Yeah.
We all knew the consequences of aligning official rate with the roadside rate. We knew that all the while. But now that central bank has taken that position, we now start shouting about the inflationary implications of that. People like us have warned the government about this, that we must be careful in terms of how we manage that. But what that also points to is that you must be clear as to which sectors are most important in terms of job creation, which brings inclusive growth. And so if we must return now to allocation strictly, then we must pay attention to the sectors that will give us the best value from those allocations.
And talking about paying close attention to the sectors that will give us the best value, we also have to look at conversations around structural policy and institutional frameworks. But at the end of the day, we also have to look at areas of revenue leakages within these sectors that have voluminous contribution to the GDP, aside oil, because that's just cliche at this point in time to say. We've not yet been able to develop frameworks that nip this in the bud. We are going by traditional template for revenue generation. How disturbing is this for you at this point in time where we are thinking of charting a stronger course of recovery to ensure that we have the Nigerian economy bounce back as it ought to after the COVID-19?
Well, thank you so very much. That is a major issue for us. There are still a whole lot of leakages in the way we run things. And the best way to deal with this is to look at what happens when you review the countries that rate very highly in the governance index chart for countries around the world. There's also what they call the democracy index. So which countries rank the highest? Why are they ranked so highly? Why is Nigeria among those that rank lowly? So when we look at that, we see the reasons that account for that, and we begin to pay attention to those reasons. For years, we've been talking about strengthening institutions. But again, you strengthen institutions so that you can, in the process, also plug leakages. So that in the process of trying to do that, hardly do we even execute, those policies, those reforms that we had agreed. Take, for example, only May last year, just about a year ago, was when President Buhari adopted the Orosai report, which was submitted to the government of President Jonathan in 2012, April. Okay, 8 years after was when we now looked at it and said, look, we need to deal with this. Now, those are the leakages, the cost of governance, and then, of course, a whole lot that we can actually harness to grow this economy inclusively.
Dr. Adedipe, we're wrapping up our conversation now. What do you make of external shocks at this point in time? What lessons do you think we ought to have learned from last year now? We have already inched into the half-year mark for the year 2021. It's time to now start assessing the budgetary performance before the year gradually wraps up. We are supposed to also look aggressively into conversation as to what needs to be done in the short, medium and long term as the Buhari administration is gradually inching closer to an end now. But external shocks, how much of a problem is this now in terms of building buffers? We have our external reserves depleting. We're not necessarily producing as much to have that exchange. There are calls for diaspora remittances and ensuring we have a bigger volume from that. We have initiatives by the CBN as well. But now, in case if there's any other shock hitting us as bad as COVID-19, do you think we're prepared for that?
Well, critically, there is only one way out of a situation like this. And this is what we have seen happen in many other countries that moved from what we call the third world to second world and first world in the last 50 years, when you interrogate what is happening all around the world. Many of them did one thing, and that was to look inwards. Insofar as at the spectrum, or let me call it the nexus of the relationship between your imports and exports, you are always dependent on imports. In our own case, as an oil-producing country, okay, we've run from a situation where we depended on the rest of the world for non-oil imports. But in the last 10, 12 years, we've also depended on the rest of the world for oil product imports, which means on both sides of the balance, we depend on foreign imports. Now we do an average of close to 1.4 trillion monthly in terms of imports. And if you interrogate the data also, in the last few weeks, how much has been purchased of foreign currencies in our FX markets. So which means a lot of value is being transferred out, but we are not generating commensurate value from the rest of the world. So we are not selling to them, all right? We are not selling enough, but at the same time, we are buying almost everything from them. So until that narrative changes, where we begin to consume what we produce and produce what we consume, our vulnerability to external shocks is unlikely to change. And I want to strongly advocate again to the government that they must provide leadership here. The government must deliberately look at its own expenditure and take a very firm position that every 1 naira we spend, a certain percentage of that must be used to buy things that are made in Nigeria, which means you have to forget about the sentiment about quality. Other countries that evolved did not talk about quality when they were in the kind of crisis Nigeria is in today. The most important thing was we buy whatever is produced in Nigeria, and of course, if we can't get something better, then we live with what is available.
Lastly,
until we come to that very tough decision. I mean, I don't see how we can escape those external shocks anytime they occur, like you asked.
Lastly, Dr. Adedike, I would like to let us play pundit here. Now, what's your next forecast for the GDP report? By the end of this month, we'll be expecting the Q2 report for the year 2021. In the next few days, barely 14 days, in a fortnight, we'll also be expecting inflation reports for the month of May as well. What's your forecast? And playing with data, we have to be very critical and then silence this noise of a lingering controversy that we have around for now.
Yeah, thank you very much for that. Now, I will not be surprised if there is a further improvement in the rate of inflation. Why is that so? Now, we're already into the rainy season, quite all right. And if you look at the data in Nigeria historically, unless there is an external shock, usually, or there's massive economic recession, like, of course, what we have had twice now in the last 5 years, the usual pattern is that inflation rate tempers as we move into the rainy season and there's an improvement in farm produce and agricultural output. So when that happens, the surfeit of supply in the agri market and that surplus makes prices to dampen. And when price of agri output dampens, it shows in the food inflation, and that, of course, take that along with core inflation. It makes the inflation rate to drop. So I will not be surprised if there's a further marginal improvement in the rate of inflation, all right, on the one hand. Now, for the GDP growth rate, we may not see that data until maybe late in July or early August. But my view about it is that we may likely see a further improvement in the GDP growth rate, but nothing as high as probably 1% yet. And my reason is very simple. The major challenge we face today is security. So, and if the government does not tackle that head on, We may see security, further impacting production and ultimately ending up in us producing far less than we are capable of. So that is my, expectation when it comes to this. Now, it's also important for me to mention this. There's a difference between real inflation and expected inflation. So when people talk about what they expect, it's not the same as what becomes the reality when the data is out. So you can't begin, therefore, to doubt the data when it comes out because it differs from your expected inflation. These are two different concepts in economics. And so when I see a professional economist talk about it and mix things up, it looks very, very, unhelpful to not only the public that is listening to you as a professional, but as well to policymakers who want to hear, maybe they can pick a few things that are useful for them.
Exactly.
That's my view here.
That's why we have conversations like this to clear the air and also have stronger analysis of the data. At the end of the day, figures don't lie. Thank you very much for your time on the show this afternoon, Dr. Biodun Adedipe. It's been a pleasure speaking with you, and hopefully we have the Nigerian economy bounce a little stronger. We have all of the necessary infrastructure to also support the grid for all of the key sectors that we expect to shape the common future. Thank you once again for your time.
Thank you for having me.